Hi. Let's learn about bonds and how they work. A bond is a fixed-income instrument that represents a loan made by an investor to a borrower, typically a corporation or government. Think of it as an IOU that includes the details of the loan and its payments. Owners of bonds are debt holders, or creditors, of the issuer. Bond details include the end date when the principal of the loan is due to be paid to the bond owner and usually include the terms for variable or fixed interest payments made by the borrower. Governments and corporations commonly use bonds to borrow money for various reasons, such as funding projects, maintaining operations, or refinancing existing debts. Bonds provide a solution by allowing many individual investors to assume the role of the lender, which helps organizations access the capital they need. Bonds are commonly referred to as fixed-income securities and are one of the main asset classes that individual investors are usually familiar with, along with stocks and cash equivalents. When companies or other entities need to raise money to finance new projects, they may issue bonds directly to investors. The borrower issues a bond that includes the terms of the loan, interest payments, and the time at which the loaned funds must be paid back. The bond's initial price is typically set at $1,000, but its actual market price depends on credit quality, time until expiration, and the coupon rate compared to the general interest rate environment. Most bonds share some common basic characteristics, including the terms of the coupon rate, maturity, and credit quality. Bond portfolios will rise or fall in value as interest rates change, and the sensitivity to changes in the interest rate environment is called duration. The rate of change of a bond's or bond portfolio's sensitivity to interest rates is called convexity. There are four primary categories of bonds sold in the markets: government, municipal, corporate, and mortgage-backed securities. Bonds come in many different varieties, such as zero-coupon, convertible, callable, and puttyable bonds. Zero-coupon bonds do not pay coupon payments and are issued at a discount to their par value that will generate a return once the bondholder is paid the full face value when the bond matures. Convertible bonds have an embedded option that allows bondholders to convert their debt into stock at some point, depending on certain conditions like the share price. Callable bonds can be called back by the company before it matures, and puttyable bonds allow bondholders to sell the bond back to the company before it has matured. The market prices of bonds are based on factors such as the credit quality of the issuer, the length of time until expiration, and the coupon rate compared to the general interest rate environment. A bond's price changes in response to changes in interest rates, with an inverse correlation between bond prices and interest rates. When interest rates go up, bond prices fall to equalize the interest rate on the bond with prevailing rates, and vice versa. This is why bond prices vary inversely with interest rates. Yield to maturity is the total return anticipated on a bond if the bond is held until the end of its lifetime. It is a complex calculation but is quite useful for evaluating the attractiveness of one bond relative to other bonds of different coupons and maturity in the market. For example, XYZ Corporation wishes to borrow $1 million to finance the construction of a new factory and decides to raise the money by selling $1 million worth of bonds to investors. Under the terms of the bond, XYZ promises to pay its bondholders 5% interest per year for 5 years, with interest paid semi-annually. Bonds are a type of security sold by governments and corporations, as a way of raising money from investors. From the seller's perspective, selling bonds is a way of borrowing money, while from the buyer's perspective, buying bonds is a form of investment because it entitles the purchaser to guaranteed repayment of principal as well as a stream of interest payments. An example of a bond is a corporation that wishes to borrow $1 million to finance the construction of a new factory and decides to raise the money by selling $1 million worth of bonds to investors. Under the terms of the bond, the corporation promises to pay its bondholders 5% interest per year for 5 years, with interest paid semi-annually. Bonds tend to be less volatile than stocks and are typically recommended to make up at least some portion of a diversified portfolio. Bond prices vary inversely with interest rates and tend to rise in value when rates are falling. Experts advise that as individuals get older or approach retirement, they should shift their portfolio weights more towards bonds. Most online and discount brokers offer access to bond markets, and you can buy them more or less like you would with stocks. Treasury bonds and TIPS are typically sold directly via the federal government and can be purchased via its website. Here are 3 key takeaways. 1. A bond is a fixed-income instrument representing a loan made by an investor to a borrower, typically a corporation or government. 2. Bonds tend to be less volatile than stocks and are typically recommended to make up at least some portion of a diversified portfolio, especially for individuals approaching retirement. 3. The market prices of bonds are based on factors such as credit quality, length of time until expiration, and the coupon rate compared to the general interest rate environment. Hope this would help. Thanks for watching.